Very happy to welcome to Forward Guidance Spencer Jakab, the author of The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. Spencer, great to have you here. Welcome.
Hey, thanks for having me, Jack.
Your day job is you're the editor of Heard on the Street for the Wall Street Journal, beloved part of the paper. So I just want to ask, the fleecing of small investors, that in the title in your book, how bad is it? With the benefit of hindsight, 2.5 years, how bad was the fleecing? Why do you call it a fleecing? Because temporarily, retail investors made a lot of money. At least that's the narrative. And
Right.
who did the fleecing?
Yeah. So fleecing is probably a rather strong word, but it happens all too frequently on Wall Street, where the way that the whole system of incentives is set up. It's a way of transferring money from the inexperienced to the experienced, from the small investors to large institutions. And this whole episode, the meme stock squeeze and the things that came before it and came after it, were very enriching for Wall Street and not very enriching for individual investors. And there are people who say, and I get a ton of hate mail, Jack, people saying, well, I made money, or I know someone who made money. Of course, they're individuals who did very well. You get in at the right place at the right time, even just through dumb luck, you can make money in any sort of financial calamity. But writ large, Wall Street made a ton of money off this. And that's not the narrative, certainly, that initially emerged, even in the Wall Street Journal. I think the kind of the first draft of history is written by journalists, and the first draft is really what people remember. There's a movie that just debuted this week called Dumb Money,
Mhm.
which exactly kind of repeats that. And that's the kind of the fun story, is that they pulled one over on Wall Street, but they really didn't. I mean, Wall Street is made up of lots and lots of people, and most of the people on Wall Street aren't really risking their own money, and they're not even risking other people's money necessarily. They're just kind of doing transactions, and they're very, very happy to see a bunch of new people show up who have funny ideas about stuff.
I haven't seen the new movie, but I saw a documentary on HBO, and I have to say, from an editorial point of view, a lot of the editing, the music was great, but that just typified the narrative. And they interviewed someone who was really down on his luck. I think maybe living out of his car, and they showed him a picture of him on Robinhood buying GameStop for like $400, and he said, "I just screwed over Wall Street." And I tried very hard to not turn it off, and I succeeded. I think I watched the entire thing, but
Mhm.
the narrative that the retail investors were screwing over Wall Street, it was true for maybe 4 days. My
Mhm.
question is, was it ever true? The narrative that the retail investors screwed over Wall Street, and at last they benefited at the expense of Wall Street. Just reading your book, there's a Mark Cuban tweet saying something like, "Thank God, at last, the hedge funds, instead of being screwed over by high frequency trading, retail investors are flipping the tables." What's wrong with that?
That's what got me, as I'll admit, that's what initially, and I'm talking initially in the first half hour, got me very excited about this. I have three sons. So, GameStop, for those who are unaware, we're living on Mars, was the company that was at the center of all this. There are other meme stocks, but that's the sort of the OG meme stock. And it's a retailer of video games, a kind of a rapidly shrinking one, already was shrinking at the time. I've got three sons. My oldest son is 24. My youngest is 17. So this sort of, I've been going to GameStop almost the whole history of GameStop, driving them there and whatnot. I don't anymore because there isn't one near here. But I was very familiar with the sort of the challenged nature of its business during this kind of era of digitized everything. It's kind of like Blockbuster 5 years before Blockbuster went bust because of Netflix. But one of my sons, who was home from college because of COVID, said, "Dad, are you going to write something about GameStop?" And I why would I do that? And I took a look and I saw how much it was up the last few days. This is before articles had begun to appear. And he was on this forum on Reddit, and some of his friends were, and some of his friends were participating in this squeeze. So I started to read it, and I immediately was just gobsmacked because what I saw unfolding was something that had not really happened in a long, long time legally on Wall Street, which is a corner, or an attempted corner, where you attempt to basically use the markets to force someone to pay almost any price, an unlimited price, to buy back shares that they have shorted. And that's what they were trying to do. And that's what I found so amazing, that these guys using social media, because Jack, if you and I both had hedge funds and we got together and we found out that a third hedge fund was really short some stock, and we got together and maybe got some other funds together in a smoke filled room and tried to squeeze that fund, that would be illegal. That has been illegal since the security laws were rewritten in the 1930s, right? It used to happen prior to that very frequently, but you can't do that. But that's what they were doing, and they were doing it quite legally because they were doing it way out in the open at a place that no one on Wall Street bothered to check, which was this Reddit message board, because they just didn't take it seriously. And so that's what I found amazing. And for about a half hour, I thought like they're flipping the script on these guys. Then I realized like they're not going to succeed in this corner, and what they're going to do, and it played out over the next week or so, is it just went higher and higher and higher and sucked in more people. Millions of people literally jumped on the bandwagon, and we're sort of just enriching brokers and market makers, and not necessarily themselves. Maybe the people who were cynical, who got out early, made a bit of money, but the majority of people who were drawn in because they felt they were part of a movement just got left holding the bag. And maybe some of them didn't care about the money. I think some of them did not, although it's a kind of a myth that they just don't care about the money. I think most people, even if it's a small amount of money, these were not wealthy people. They missed the money that they saw evaporate when the air came out of this thing.
So it was true for a while that the hedge funds who were short the stock were screwed, and they did get cornered because what percentage of the stock was sold short? It was over 100, correct?
Yeah.
You can give numbers. And then also some, they call themselves apes, say that is a sign that the market is manipulated. But what do you say to that?
Yeah, in GameStop specifically, it was in excess of 140% of the free float was sold short, which sounds like it should be impossible, right? I mean, you have to borrow a stock, locate a borrow to sell a stock short. So how can you have 140% short? Well, it can happen. It does happen. It's not just a matter of clerical errors. I mean, the rules have changed on Wall Street to make short selling kind of much more kind of fit within the rules, and you have much less, so-called naked shorting. But you have something called rehypothecation, which allows this to happen. Whereas, let's say you wanted to short a stock, so you go to your broker, your prime broker, and say, I want to locate shares to short. And they say, okay, we have the shares. And then you sell it without owning it. But you sold it to someone who's unaware of the origin of their stock. They have it in their brokerage account. And then that broker might also lend the stock out to short because they're not aware that it's been sold out, that it's already been lent out once. So it does happen. It's nothing sinister. It's not a plot, but it is an extreme case. And so really, I mean, like I'm shedding no tears for Gabe Plotkin and these other hedge fund managers who lost a lot of money. He lost something like $7 billion of his investors' money in this whole episode, which is crazy. But they were not doing anything illegal. He actually wasn't even all that short. I mean, his fund is not a short selling fund. Short sellers anyway are vilified. That he had adopted the more typical strategy on Wall Street, which is to be net long and then to have some shorts to enhance your position. So maybe he looked rightly at GameStop, which was a position that he opened when his fund opened many years before that. That GameStop is a loser. Other stocks, maybe Bed Bath and Beyond, or not Bed Bath and Beyond, sorry, Best Buy or something like that, is in a similar category, but I think they have the right strategy. It's a winning company, and GameStop is a losing company. So I'm going to not just like a regular mutual fund, put my shareholders or my investors' money into that good company. I'm going to enhance it, basically borrow money by also selling short some dud but closely related company in terms of being in the same industry, and then use those excess funds as leverage. And that's why things unwind so quickly. It's done by even mutual funds sometimes engage in that strategy, but hedge funds in particular. And they're not out to destroy a company. You can't destroy a company by selling its stock short. It's just a complete myth. And
yeah. So that is totally untrue that short sellers can destroy a company. A company performing poorly makes short sellers money, but they have no control over the business of the thing. And also, its decks are stacked against the short sellers because stocks go up over time, and
right.
they have to borrow it. The most they can make is 100%, and they could get squeezed. And so if you have a stock that has 60% of it is sold short, odds are it has some issues that professional investors, people who are doing a lot of work on this stuff are very worried about. With the benefit of hindsight, I mean, a GameStop being 140% short squeeze, that seems like horrible risk management. And you said it's not sinister that something could be rehypothecated and a stock short more than 100%. But I would say, maybe is it not a good thing? Maybe there should be some regulations. I mean, a lot of in your book, you call for some regulations to sort
Right.
of tame the animal spirits of the market. Maybe that would be a good thing to say, hey, if something is 70% sold short, that no more short sales or something like that.
Yeah, I mean, the 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 only proposals that really have come out of this, and not much has been enacted, have specifically been aimed at short sellers, because that's what always happens when there's a crisis, either during or after a crisis, whether it's '08 or the flash crash or whatever. Is short sellers are very easy to vilify. So in terms of when politicians and regulators who are hired by politicians get sort of are fighting the last war, basically, that's typically the group that they'll go after. I mean, short sellers, you can go back to the beginning of stock exchanges in the 1600s in the Netherlands, and even then, there were campaigns and actual kind of punitive actions taken against short sellers, because it's seen as something that's anathema to everyone else. But short selling is something that's unfortunately, it's a vital part of how markets work. Short sellers provide liquidity to the market, because when you have a stock, you have to be able to you have to do more than just vote for or abstain, right? You can buy a stock, or you can say, I don't really like that stock, I'm not going to own it. But what short sellers do is they take the no vote. They say, not only do I not want to buy the stock, I think that it's going to go down. And many stocks are either overvalued or perhaps even outright frauds like Enron. And so short sellers provide a vital function. Not that they're angels, but having them continue to operate is good. Now, 140% was horrible risk management. Think about, though, if you're Gabe Plotkin's risk manager, and you're like, Gabe, this stock is 143% sold short. Maybe you better be careful. Yeah, he should have been careful. On the other hand, that this was such a, I don't know what sigma event this would be, some 15 sigma event, because never has a company this troubled gone up this much. It was a completely kind of manufactured crisis in that sense, right? Because he you could have had something happen, some really good news for GameStop, or someone comes out and buys it, or whatever. Ryan Cohen comes out and says, I'm paying 100% premium and buying the stock. And it would be a really bad day for his fund. But you're not going to have the thing go from $2 to $483, from anything normal happening, right? It only happened because you had this concerted effort that really kind of built upon itself, that was discussed very openly on these message boards. That's why I found it so incredible. I wrote an email right away to the acquisitions editor at Portfolio, an imprint of at Penguin Random House, and like, oh, I haven't heard about that. Do you have a proposal? I'm like, no, this is happening now. It's going to be happening now. And and once I had a day or two to think about it, I kind of saw it for what it was, which is really a kind of a cautionary tale, but an incredible story too.
So I think you're saying this wouldn't have happened if folks on Reddit, Wall Street Bets, hadn't acted in a coordinated way to pump the price up,
Right.
and then influencers like Elon Musk jumped on the bandwagon, and we just spiraled out of control. We both know the story. But couldn't you also say it wouldn't have happened if a stock was sold 140% short? I mean, that is quite a rare instance.
Oh yeah.
And yeah.
Yeah, that was the dry kindling, there. And then you had the dry kindling, you could throw a match on it. But what they did is, like, they threw like some gasoline and a match and some uranium and some nitroglycerin and some whatever. Like, they 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 brought a lot more to the fire. I mean, I'm not saying that anyone is at fault. Gabe Plotkin certainly is at fault for allowing it to happen. He, should have lost some money, but losing the amount of money that he lost, and having this turn into this sort of the media and political event that it did, was only made possible by the confluence of several things. And that's what I find so interesting about this, is that all these things had to happen really within the period of several months to make this whole episode possible. And then it was a conscious act, because people saw that the hedge funds were vulnerable, and they discussed it openly. They didn't do anything illegal. They discussed it openly in a forum that the hedge funds could read. As a matter of fact, I know that they did read it, and I knew they definitely do read it now. They follow these message boards very closely. They pay people to do it, or they have software that does it today. But I mean, they're paying a lot of attention today, but they were just not taking this group seriously, and they should have.
Yeah, and I think the narrative of who the victims are and who the perpetrators are is that hedge funds and Wall Street, and again, that phrase Wall Street can mean
Mhm.
10 different things, but people group it together, conspired to screw over retail when the squeeze already happened.
Mhm.
Retail Wall Street bets had outsmarted the crowd. It went from $4 to $40 to $100 to I believe as high as over $400.
Mhm.
And then tell us what happened. What was it in the middle of the week? Something that
Mhm.
really slowed down the momentum. What happened?
Yeah. So what happened is that there was one broker in particular, Robinhood, which was the sort of the preferred broker. If you drew a Venn diagram of people who are on Wall Street bets, the kind of YOLO traders and customers of Robinhood, there is a tremendous amount, not 100%, but a tremendous amount of overlap. You had a lot of people with small accounts, and you had, for example, just in one day, you had a million accounts opened on Robinhood during this episode. So you had tremendous growth in the number of accounts. Robinhood allowed you, well, every broker enacted this eventually because they kind of threw in the towel in late 2019. Every discount broker, Fidelity, Ameritrade, E-Trade, what have you, but they were the ones who pioneered it, allowing people to trade for free. It's not really for free. We can discuss that, but
Mhm.
they allowed people to trade for no commission, and everyone else kind of threw in the towel. But they had captured this young cohort, and they did it through an app that was very addictive. That is really is an elegant thing, very much, and it's not a coincidence. Resembles the apps for things like DraftKings, these daily fantasy sports apps that young men in particular had on their phones, where it really kind of stokes this FOMO effect. It's very intuitive, very, very easy to trade. There's no friction in the app. That's what you really want. You want people not to have to do a lot of work to roll the dice, metaphorically or literally, right? When they're gambling. And Robinhood was doing very, very well, but they were contacted by the clearinghouse. Brokers have a clearinghouse, and the
This is
clearinghouse.
in late January when the stock
This,
is at $200, $400. Yeah.
yeah, exactly. It was the January 25th was the Monday, so this was the overnight, the 28th, middle of the night in California. They got a call from the clearinghouse saying, "Listen, you're going to have to come up with $3 billion of collateral in order to kind of cover the variance on these trades, because what you have is basically three, four, five stocks, that all the meme stocks, as it wasn't just GameStop by that point. It was a bunch of stocks that all had this kind of heavy short interest, kind of loser status in common, and had seen a surge in price and a surge in activity. All these guys, they're all long, so they're all taking the same part of the trade. A lot of them are using options, call options, in order to trade this thing. And by using call options, what they were doing is, sort of, it wasn't just individuals who owned the stocks; it was a bunch of options dealers. So if you look at what was discussed on these boards, they're saying if you really want a lot of bang for your buck, instead of buying the stock, what you have to do is get permission to trade options and buy out of the money, uh, short dated call options. Because if you understand the math behind Black Scholes, that is the thing that creates the most hedging on the other side. So if you're an options dealer, you don't care. You're just doing business. You're just transacting. But if someone shows up and it's a $10 stock and they say, like, okay, I'm going to buy a $15 call option for this thing in 2 days. Well, the odds of that thing going to $15 are infinitesimal for a normal stock, unless it's just a crazily volatile stock. Even then, right? It's not going to go up 50% in 2 days, but you'll take that money, you'll take that person's money, and you won't necessarily hedge it right away. But if it starts to rise and then it gets to $14 and $15 and $16, then you have to buy the stock as a hedge, and you have a lot of money. So this person put down pennies, and you're putting down dollars and tens
Mhm.
and hundreds of dollars in response to their bet that was initially worth pennies. And so it's like a nuclear weapon. And they understood, and they were openly discussing it, that that's how you can get much more bang for the buck. And so there was so much money betting on the same side of this handful of stocks that the clearinghouse said, if this reverses, you've loaned a bunch of margin to these people. You've allowed people to open accounts without actually transferring the money to you, because you had a bunch of people opening accounts just that week. And Robinhood, basically, in order to make things very viral and addictive, you could just show up. You could be sitting and I hate to stereotype, but I will, sitting in a dorm room, late at night, doing bong hits with your buddy, and be like, dude, I've got a Robinhood app, and like, check it out. And if you open a Robinhood account, I get a free trade. and you get a free trade. I get a free stock and you get a free stock. And it's like a sweepstake. I don't even know what stock it is. It could be Tesla, which is worth a lot more money than you put down. All you have to do is put like $20 down, and you open an account, and you can trade right away. And Robinhood would allow you to do that because as soon as you initiated the transfer, they were like, okay, your money's it's going to arrive in a couple of days. You're good. You can trade right away. Of course, they want you to trade right away because you're sitting in the dorm room doing the bong hit with your buddy, and the idea is going to be out of your head. You're going to be on to the next thing in 3 days when the money settles.
So the reason that, let's just say, Schwab or Interactive Brokers or Morgan Stanley, the reason that they didn't have to halt trading, although maybe some did, you tell me, is because why? Because their clients weren't using as much margin. In other words, if everyone had done the exact same thing, but on Robinhood, but they had bought the short dated call options and they bought GameStop, using their own money, that a funded account instead of margin, would this not have happened? Is it the margin specific? And by the way, for folks, margin means borrowed money.
It's not specifically that because there's a settlement period for stocks, right? The stocks don't settle right away, so you pay for it a couple of days later. You don't know. You can't look into the accounts of that. If someone bought a stock and then the value collapses, which did happen in this case. We will discuss what kind of accelerated it happening, right? But it did happen. You knew it was going to happen. This thing didn't go from like $2 to $4 to $483 without the possibility of a serious reversal. Then you might basically be sitting on a loss. If you had just opened an account, or you were a person with a very small amount of cash and securities in his or her account, then it was quite likely that you're just going to walk away. You're going to you can come after me for the money, but I know I paid for this stock, but there's not enough money in my account. And so it's just a normal course of action that they did their calculation. They said, we need $3 billion. Of course, there's no way that Robinhood, which is a pretty small broker, could come up with $3 billion. It's not backed by a bank. It's not Charles Schwab. Even Charles Schwab would have difficulty coming up with $3 billion in 3 hours. There's no way they were going to be able to do it. And they were about to be out of business. If they had been out of business, then the price would have collapsed anyway, right? Because if your broker tells you, like, I'm sorry, we've halted all transactions, you should get your money back when we're wound up in a few weeks, then all this action would have ground to a halt anyway. Plus, there could have been a cascading panic in the financial system, because if one broker goes bankrupt, the job of the clearinghouse is to protect all the other brokers. They depend on each other. It's there's kind of a mutual type relationship that they have, and so it would have been a financial hit to everyone else in the system. Perhaps not a devastating one, but it could have been. We came fairly. Mohammed Al-Arian, spelled out a few days later how dangerous it was and how it could have caused a kind of a cascading crisis in the brokerage community. Anyway, that's not what happened. They said, okay, how about if we don't allow people to buy anymore? We only allow them to sell. We don't allow any more options or stock trades in this list of stocks that you've identified as being most vulnerable. And they came back and they said, okay, in that case, and they did them a favor. They said, I think it was something like $780 million, which they just barely came up with. They basically raised the money that day. They drew down their bank lines overnight, raised money that day, raised some more money the next week, raised about $1 billion at the end of the day in order to cover this margin. But the conspiracy theory is that they took away the buy button. They didn't allow you to buy, and other brokers also were caught up in this. Interactive Brokers and people
They did take away the buy button.
hearing in some, but they were the most affected by far, and they were the ones that had the most accounts. So you could say, hey, this is bullshit. I want to buy more GameStop. I'm going to set up an account at Fidelity. Okay, but Fidelity didn't allow you to set up an account instantly that morning and then start trading the stock, right? They're a normal, kind of more prudent broker, not catering to kind of people who are in their 20s. They cater to people who have a lot more money, who are in their 30s, 40s, and 50s, who have retirement accounts and stuff like that. And they don't allow you to trade options right away. They require you to fill out a paper form and mail it in, rather than just filling out some forms online and immediately claiming that you're an experienced investor and trading options. And so they weren't able to continue this momentum, and the whole thing collapsed. It did peak briefly that morning and then began a collapse and was down very, very sharply in the ensuing trading sessions, which brought an end to the initial kind of meme stock squeeze. But there's this conspiracy that it was done to bail out the hedge funds.
Mhm.
And I
People who are short the
think that
stock.
there's circumstantial evidence. There's some coincidences there that kind of reinforce that notion. I can happy to discuss why I don't think so, but I have no dog in this fight. I'm not, on Ken Griffin's payroll, but Ken Griffin of Citadel Securities and Citadel, the gigantic Chicago hedge fund, or now I guess Florida-based hedge fund, he moved to Florida, whatever. But that he was seen as some sort of kind of eminence grise behind all of this, and manipulating events, and that's still the conspiracy theory online. He's like this vilified figure among the meme stock traders.
So I still don't understand the mechanics of why Robinhood. I mean, I get that they were under a lot of pressure, and so they had to degross and lower their exposure. But in terms of the clearinghouse and what they have to do, who was the one who said you have to post more collateral? It was the clearinghouse, and under what circumstances? And explain how that ties in with T+2, which basically means if you buy a stock, it's not
Mhm.
settled until 2 days. I mean, what does it mean to for something to settle? Like I bought, Apple today, and it
Mhm.
says it's in my account as soon as I bought it, but it's not settled for 2 days. What does that actually mean?
What that means is, I mean, if you go to your whatever broker that you might use and you say, I want to buy 100 shares of Apple, it'll show the money going out of your account, and it'll show 100 shares of Apple in your account like it happened instantly. But that's not the way it happens, and that's never the way that it happens. There are some financial markets where the transactions are instantaneous, but for stocks, even though it's dematerialized. I mean, there used to be actual stock certificates that had to move from, be stamped and move from one account to the other, and there's paperwork involved. Things don't settle right away. So the money has, come out of your account, but it's in a stasis, and the money hasn't been delivered to the person who sold it to you. Whereas someone on the other side of that transaction, it went through a broker usually, or through a market maker. There's someone there who sold 100 shares of Apple
But
or
they
some,
they have the money, right? They sold 100. That's what, 114,000.
but they do not have the money right away, so they're owed the money. So if you have 100 shares of Apple in your account right now, Jack, and you sell it, then 100 times whatever the price of
Fourteen
was
thousand, whatever. Yeah.
sold it, it shows that money is being in your account. Your broker can't call you up and say, that money's not really in your account. It shows it as an unsettled trade. If you look at it, it said, cash awaiting settlement. You can trade with it. You actually can take that money and trade with it. So your most brokers will front that money to you, especially if you have a margin account, which Robinhood allowed people to open rather than just a cash settlement account. You sold a bunch of stock and you have $1,000 in your account from a stock you just sold 2 minutes ago. You can take that $1,000 and you can buy something else, but you don't really have that money. They're fronting you that money. They have to have a balance of cash. And if that money never arrives because the person who was supposed to have paid for that doesn't actually have the money, or their account closed down, or they didn't transfer it, or whatever, then there needs to be some kind of cushion in there. And these events were so extreme and so one-sided, so concentrated in a handful of stocks, and there needs to be some prudence there. And these were reforms that were enacted, by the way, in the wake of the financial crisis. This is part of the whole Dodd-Frank and Volcker and whatever, all these rules that were done to address the last crisis to make the financial system more stable. They said, okay, well, our calculations show, our risk managers say that you need to put up $3 billion in cash, which was there was no way that they could do. They would have been out of business. It was 3 o'clock in the morning, California time, 6 o'clock in the morning, New York time. Markets open at 9:30, so it was barely 3 hours before the markets open. There's no way to raise that kind of money. Now, as it turned out, people were very willing to give Robinhood money because Robinhood was not insolvent, right? Robinhood was having the best week in its history. It was having a great, great, great week. Its reputation took a bit of a hit in this episode, but it was having the most profitable week that it had ever had because you had this gigantic surge in trading. And the way that Robinhood gets, even though you don't pay anything for trades, it gets paid for trades. And the stupider the trades you make, the wilder the trades you make, especially if they're options trades, the more it gets paid. Because the way that Robinhood makes money, you don't make money, Jack. You can set up a store selling something, even if it doesn't cost you anything. If you sell it for zero, and you have a whole staff doing that, you're not going to make any money, right? Robinhood wasn't giving this stuff away for free. It wasn't charging its customers. Instead, it was selling those customers' trades to market makers like Citadel Securities, among others. Citadel Securities was the largest one, still is the largest one, where instead of going to a stock exchange, they said, we'll pay you for this order flow. We want to process those orders, and we'll give you at least as good of a price as you can get on the stock exchange. But we'll take a little fraction of a penny on each side of the trade because we have very good software and very good computers and very fast computers, and we'll fill that trade. And then we'll pay you a bit and we'll keep a little bit. And so we want as much of your business as you can throw our way. And that's what I see as problematic, and something, not payment for order flow necessarily, but just the way that this whole zero commission business is enabled. And that's where I see a need for some regulation. As a matter of, when I watch any sporting event these days, myself or with my sons, I see an additional need for regulation of outright, actual licensed gambling, because that is all you see. And you have just an explosion of actual gambling going on. And I see a very, very fuzzy line between this and that, and a lot of what's going on with crypto exchanges as well. Where it's just in speculators' minds, it's all the same thing. It's all this kind of get rich quick mentality. I don't see a big, it's, in some cases it's more entertaining than sporting events, right? I mean, so and by the way, the explosion in sports gambling and the legalization of it actually, in my opinion, played a role in this whole episode. And I can, if you want to discuss that later, we can go into that.
So when people bought GameStop on Robinhood, so what was Robinhood's exposure before the trades didn't clear? Were they basically like short GameStop, or
right? I mean, Robinhood doesn't take a risk.
Then why do they have to post collateral?
Well, because the trades had not been paid for yet, because Robinhood owed the cash. So you had some cash on your account or some margin borrowing ability on your account that Robinhood provided to you. It provided margin on very favorable terms to a lot of its customers, where basically it would lend you the money, but it only had so much in terms of credit lines. Or you could open an account on Tuesday, January 26th at Robinhood. Say, I heard about this meme stock thing. This is great. I'm going to put all my savings, $1,000, which will arrive on Friday, for my bank account. There's a wire here. And now I have $1,000 that I can trade with. And I'm going to take the $1,000 and I'm going to buy options expiring on Friday that are, way out of the money, that I'm definitely going to lose money on, or very likely to lose money on. This money arriving Friday. And then I'm going to take other, and then do other trades as well. And so they didn't know that they were good for the money. Robinhood did not actually have the cash in its account for those people. And when it lent people money on margin, it was using its own borrowing lines to provide money to those people. Margin borrowing is, there are defaults, and Robinhood had much higher rated defaults than other brokers before this anyway. But it's not a very risky business, because they lend you money pretty dearly, and then they have collateral, which is the stock. So
right, so they were long loans that were collateralized by Robinhood stock, but that stock was so volatile that you didn't know if you could. Although you could close people out, right? I guess that you could.
Yeah, if you default, you can close people out. But what if someone bought stock at $400, and then the stock went to $110, like it did 2 days later?
Mm-hmm.
Well, what's that share of GameStop worth? How much of the loan does it cover, given the?
But if you gave someone a 50% loan, couldn't you? So 50% loan to value, couldn't you automatically liquidate it when it was $200? Or
you could, but there was such a cascade of selling, and the stocks were frequently halted, that it wasn't necessarily possible to make yourself whole. I mean, the volatility was such, if you're the clearinghouse, I don't think the clearinghouse is at fault here, because they had these rules that were instituted after the financial crisis to make sure that there wasn't this cascading set of losses. And the reason that conspiracy theorists kind of have a few threads to latch onto, they said, oh, they took away the buy button. I couldn't buy. I could sell, but I couldn't buy. Well, yeah, because of the buying was the problem. They were quite happy if you exited the trade. Separately, Gabe Plotkin's fund got a financial lifeline that week from Ken Griffin, from
Who
his head.
owns Citadel, the hedge fund, and who also owns Citadel Securities, which was the major payment for order flow market maker.
He was the controlling shareholder of both, of the hedge fund and of the securities firm, which are two separate firms. There's no evidence that they spoke with each other. There's never been any impropriety there, but it's the same person. It's the same name. Maybe you should have called Citadel Securities something else, right? Castle Securities or whatever, renamed it, right? Because it's, you know, it seems like even more of a conspiracy that he did it in order to protect his funds investments, because he had made a kind of a revenue investment. He had given a lifeline to Gabe Plotkin's fund, Melvin Capital, and also taken what's called like a revenue shares, basically. So his investment would do better if Melvin Capital did better. And so there was like,
But Melvin Capital would not do better if the stock continued to go up. And that's also, when did they exit their position? You claim in the book that Melvin Capital and some of the original shorts had fully, or I don't know if you say that, but largely gotten out of their short position before the giant squeeze, and that there were other funds who got shorts that they've propelled the later squeeze from 100 to 400. Tell us about that and sort of the sourcing and when you were writing the book.
Yeah, I can't discuss all of the sourcing because it's a hedge fund, and people who spoke to me, but by the close of trade on the 26th, so 2 days before the stock peak, so it was at approximately half of its peak, they were completely out of the trade, but they still lost in excess of $6 billion, almost $7 billion on a variety of positions, mainly GameStop, but also other things, because what you had is a bunch of dud stocks all rose in unison. You also don't expect nearly bankrupt movie chain, the former, BlackBerry, the former maker of smartphones that was like totally like a relic then. You don't expect the sort of the bankrupt rump of Blockbuster Video. You know, you don't expect Bed Bath and Beyond. You don't expect all these things that have nothing to do with one another, except that there's heavy short interest, all to rally in unison. Basically, you had people like going on Yahoo Finance or wherever and saying, "Well, where's the highest net short interest?" And then piling into those stocks because they saw the same magic repeating. And briefly, they did. There was a maker of wired stereo headphones that was possibly, I think, the best performer that week. It was the only thing that these companies had in common was that their business wasn't very good, and they weren't making any profits, and there was a high amount of short interest. And funds that look for dud companies and look for offsetting trades happen to have concentrated positions there. There are other people who lost a lot of money too, not just but Melvin Capital was the biggest victim that we know of.
Got it. So you say they got out on the 27th or 28th, or
No, the 26th. By the close of business on Tuesday the 26th, they were out. Another book out there that I won't name that has a whole scene where Gabe Plotkin is having a nervous breakdown and doesn't know what he's going to do that night, but that was just a kind of a created scene. They did not speak with that author. They were out of that trade by then.
Obviously some people were still short to get that final squeeze. Who was short? And I mean, like, was it hedge funds? Was it sophisticated retail investors who said, "Hey, I'll short the stock"? Because if I recall correctly, it was very hard to borrow the stock, and I think on some retail brokerages it was impossible to borrow the stock. So in the same way that the longs were being shut out, the shorts were as well. The retailers were saying, "Hey, we're not going to don't try and short the stock; it's too risky."
Yeah, no, you had a lot of options dealers that were short, for example, that had to be short in order to hedge their positions, because you had a bunch of this was like a real. So you basically you had turnover, I think, in the short position. You had a bunch of people who, after GameStop was up, I don't know, 500%. You had people going, "This is stupid. I'm going to short this and make out like a bandit because these kids are morons." And I'm going to, if you were smart, you bought puts. You paid a very rich premium, but you bought puts. So you used options to bet on a falling price. And if you were dumb, you actually located and shorted the stock because other people were getting out of the trade, and then you shorted it. And so there are other funds that that you don't necessarily know about who on that Monday and Tuesday and Wednesday and Thursday were losing a ton of money. I know
Because they were long puts.
yeah, they Well, by either by purchasing puts or by locating a borrow, because it was possible to locate a borrow and to actually short the stock. If you short a stock conventionally, you go and you go to your prime broker. If you're a hedge fund, you say, I want to locate a borrow and I want to short this stock, AMC or GameStop or any of the meme stocks, and they can locate a borrow, then you can short the stock, but you're on the hook for infinite losses and you might get stopped out. If you're smarter, then you might have, and Melvin Capital, by the way, also had puts. That's how they got exposed to this.
Mhm.
They were they were kind of not really known until they also do their required public securities filings, 13F, disclosed that they had puts on GameStop that fall and winter.
And puts you have to describe, you have to disclose because it's a long position, where short sales you actually don't have to.
That's right. Yeah, short sales you don't have to disclose. Just the way if you have a small long position, you don't have to disclose it. But if you have an options position, then you do need to, and a long options position exceeding a certain size, then you do have to disclose it. And so they did, and so they were identified as a sort of a target. And it was openly being discussed. You can go back to October, November of 2020. You can see all kinds of discussions about Melvin and let's screw Melvin, and we're going to get these guys. Their positions were not totally transparent, but that was known. And they were also, as we know, very, very heavily short the stock itself. But you had new people. As this episode was going on, you had people saying, this can't possibly go on. This thing is up so much. This is going to unravel. These kids are dummies. And they totally underestimated how far this would go and what a phenomenon it would become. And so they also got, those people got blown up. But you and I obviously know a lot of people on Wall Street. And when my book came out, or people heard my book was coming out, people who I know personally were like, "Oh, Spencer, this is great. I made 300 grand buying puts on this thing. This was what a great week for me." Just people who just had a bit of, basically had staying power and didn't get stopped out, made small fortunes. I know a lot of people who made, I wasn't advising anyone to do anything. I'm just a reporter, but I mean, people after the fact told me how well they did out of this episode. Most of the people, Jack, who made money on this were on Wall Street, not in mom's basement.
Yes. How would you assess the investment record of Wall Street bet? Who made money other than Keith Gill, who is deep
Right.
fucking value? There were some folks who followed him into the
Gill,
trade. Obviously, a ton of people.
yeah,
It's so typical. Like if there's stock trading at $1 and 5 people get in it, and then it goes to $20, everyone's going to get in at $20.
right,
Like for example, everyone's got into oil stocks. Everyone became an oil stock investor when oil
right.
went to $20. Whereas the people who made
Well,
money got into it when people were talking about oil is not going to exist.
yeah. Well, I'll tell you who made money. It's many categories of people who you would put under the label Wall Street, right? You had Robin Hood.
I'm talking Wall Street. I'm talking the longs, the people who
Belongs. Okay. Well,
Oh, yeah.
it was mostly people who were value investors who saw something in GameStop. GameStop wasn't a completely lost cause. It was a very, very, very beaten down stock. So you had Michael Burry of Big Short fame, who took a long position that he disclosed in 2019 in GameStop. He owned about 5% of the stock in GameStop, and he had a thesis. He didn't make money because of his thesis. Maybe he would have if everything had just kind of gone normally and this wouldn't have turned into an episode that I wrote a book about. He might still have made money. He might have been right because he saw it as a cigar butt. He said it was they can do some things to salvage value in this company. It's not a $5 stock or it was what, a $5 stock when he bought into it, and certainly not a $2 stock. We got down to about $2, during the height of the kind of COVID panic. It's a $10 stock. I think it's worth twice as much. And that's why I bought the stock. He didn't think it was a $483 stock, and in fact, he sold well before it got there. But he made a fortune, and then he said, "This is insane, and this is wrong. What's happening with the meme stock squeeze?" There was Joel Tillinghast, who was through his two funds that he had at Fidelity. He's a famous, just recently retired value investor. He owned about 13% of the stock. He made a bunch of money, but he sold. He didn't wait for the peak. He was like, "This is stupid. This thing, once it doubles or triples or whatever, I'm getting out." He's a disciplined, normal investor. He'll just take his winnings and not push his luck. But in the other meme stocks, you also had people who made a lot of money, and also made a lot of money, not traditional longs, but basically insiders in the companies who had options, who had restricted shares. that they suddenly unlocked. You had a guy who was on GameStop's board, who was a classic value investor, who fought to get on the board because he wanted to turn the company around. And he and another investor took a big stake. One of the guys said, "This is like going to Disneyland. This is so great," because he was not the one who got on the board. So he sold out during the meme stock squeeze. The other guy couldn't sell out because he was on the board. It was his bad luck that they're like, "Okay, Kurt, you be the guy who goes on the board." So he had to wait several weeks before he basically resigned from the board and then could sell his stock. It's still at a pretty okay profit, but not as high as the other guy who helped vote him onto the board. So we had a bunch of people who were just right place at the right time, who didn't see this coming, but very much Wall Street guys, who just made out like bandits. And then management, who then after the fact were cynical, who sold a bunch of stocks to these enthusiastic investors who were waiting for lightning to strike a second, third, fourth, fifth time. AMC being the worst offender by far. I mean, we could
We'll go
5 hours about that, but
yeah.
that's a whole other story, right?
So, so those people who made money being long the stock, I'd say those are structural longs and strategic longs, value investors. I mean, you can include Keith Gill in that category, definitely originally, as well as people inside management. I mean, to talk about AMC just real quick. There's a private equity firm that got able to cash out at a ridiculous deal because they were long. So people who got long the stock not because they were trying to squeeze the stock. My next question is, people who tried to squeeze the stock and obviously were very successful, how many of those folks were, maybe were retired from Wall Street? I mean, there's a lot of sophistication definitely to know how to squeeze the stock. How many were retail on Wall Street bets? And then how many, I mean, now I'm the one who can't disclose my services, but, I heard that anecdotally that a lot of funds were, especially high frequency trading firms and volatility trading firms were making a lot of money by, GameStop went up, we'll bid up AMC. Oh, AMC went up, we'll bid up some other meme stock. And that a lot of institutional money went the way that went long. And not, it wasn't just Wall Street was long as well as short.
Yeah, totally. Yes, I agree. I don't have hard evidence to give you dollar amounts of who made money, but I have a lot of circumstantial evidence that tells me that obviously the money, something goes up from 4 to 400 and then back to 20 or 50 or whatever. Money's made along the way. The shares of this company turned over many, many, many times during this episode, right? Money's being made and lost. And I agree. And I suspect that even in the genesis of this, or maybe once the ball was kind of getting rolling, weeks before we knew what an ape was or what a meme stock was, there are people in there who were probably even planting the seeds of the idea. If you look at, and I have some of the excerpts in my book, you look at the sort of the people saying, okay, here's how this thing is called a gamma squeeze, and this is how you do it. Maybe they didn't call it a gamma squeeze because that'd be too complicated, but they said, this is what you have to do. They were pretty sophisticated.
They definitely got it. And they got it more than the people who were paid millions of dollars to get it, who were short the options and short the stock.
They got it.
They definitely uncovered a cheat code in the financial infrastructure. And it was you tell me a legal cheat code where if there were a bunch of hedge funds doing it, it would be illegal, but they were just it was decentralized people posting online, not institutional investors. And that was very successful. So I guess, what percentage of the people who tries to squeeze the stock got out successfully? Because there were a lot of people who were feeling very, very, smart and successful and had made a ton of money when the stock was at the peak of, over $400. How many people pressed the sell button? Keith Gill, I think, pressed which actually I didn't know before reading the book. He pressed the sell button a little bit and sold some, but held on. And so how many people sold out? Because wasn't there also a dynamic of, if you're sell, you're a coward. You're as them. And that's where I think it starts to get toxic.
That's right. People, if you ask, if you wade onto one of these message boards and you're like, I'm not selling, I never sold, I held on. It's like this badge of honor to have sold on. But we know that people sold. We know that probably the majority of people sold out, and because it's not a monolith, you have this group, and it's like, if you have, I don't know if you're a member of a church or some patriotic group or some environmental group or something that people feel kind of deeply about on an emotional level, right? Which is then this really was almost like a religion, right? People who are late adopters, people who join late, aren't they always the most zealous, right? And so I think that the point at which this became a movement, those are the people who are very likely to have lost money, where they're like, this is a movement, we're going to screw the man, we're going to show them, we're turning the tables. And that was the initial narrative. And most people only read a few articles about this. They read the articles that appeared that week, which had that narrative of like, they gave Wall Street a black eye, things will never be the same again. And that's just not true, unfortunately. I wish that it were true, because it'd make for a much better story. Still a great story, but it'd make for a much, much better story. It made for a good movie, which is in theaters now, not based on my book, called Dumb Money. But it's, that's the narrative. But no, I think that some people who were opportunistic, who got in early, probably got out in time. Very hard to time these things, obviously. I made twice my money. Oh, I made four times my money. I made, I don't know. At what point do you sell out? If you see something going up and up, there are people, look at Isaac Newton, right? Possibly the smartest man who ever lived. He got in on the South Sea bubble. He knew it was BS. He was already pretty well advanced, and everyone was getting rich in England in 1720. He bought, and then he sold. He doubled his money. And then he just couldn't stand seeing people continue to get rich. And he got in again. And then he lost a bundle. He lost a very substantial fortune, lost more than he initially made. And it set him back for a long time financially. And I don't remember the exact quote, but I can calculate the movements of the celestial bodies, but not the minds of men. So it's very difficult to resist. There are possibly people who got in and out, who made an initial killing, but then lost money later. There's no way to tell. If you go to a cocktail party in your neighborhood, Jack, and you talk to people about the stock market, most people will be talking about money they made, not money they lost. So it's very difficult to discern from these online forums who made or lost money. Although there's a really unusual thing about these forums, which is the so-called loss porn.
Mm-hmm.
Sense that on this forum in particular, it's kind of like a fetish to have claimed to have done something dumb and lost money. So maybe that's probably one of the few things I kind of really admire about this group, is they're really into talking about their losses too. It's a one kind of endearing quality that I see there.
Yeah, I feel like I have a lot of respect for the movement, the original movement of let's screw over Wall Street and let's make money, and then let's be actually shrewd investors, and let's take advantage of where the Wall Street was way too, exposed to soft underbelly, hedge funds, shorted stock to 140%. But I feel, and you do a great job of highlighting this in the book, it changed really rapidly, because it had something like 300,000 people, but then a week later it had like millions of people, and it became an ideology. It became a revolution, as your book, the revolution that wasn't. Talk to us about that change of the old heads who were, have been on this forum since 2018. And then you have this influx of new people. And it's kind of like, you have a town that there's 50 people there. Suddenly they discover gold. And then a year later, there's 10,000 people there.
Yeah, and I mean, there's so many. I'm personally fascinated by stories of bubbles and manias and panics. I always have been. This is different than all of those, right? Because it was a movement. So you had people. This is traditional. I mean, human nature doesn't change. You have fear and greed, but you had something layered on top of it, which was I'm doing something good. I'm joining a movement. I'm gonna take my little bit of money. I'm gonna open a Robinhood account, and I'm going to buy some of this stock. I've never had a stock before. This is the first stock I've ever owned. And congratulations, you just paid, 500 times revenue or whatever for this company, which is, moronic, right? In a financial sense.
But sorry, always, and I'm sure you agree because you write about it in the book, it became a movement. It was not a movement originally. And as soon as it started to become a movement, that's when people lost money. Like the people who were part of the movement, I'd say, 90% of them made money. Whereas people who were, shrewd investors at the beginning, they, in many cases, if they got out, did phenomenally well.
Yeah. I mean, that's kind of the crazy part too, is that you can't really view this group as a monolith. Yeah, because the people who viewed it as a movement, in my opinion, there's no way to survey people, but in my opinion, just because of the timing of the price that they likely paid, if you look at the explosion in membership in Wall Street Bets, and you analyze the messages, and you look at the turnover, and you look at the number of brokerage accounts opened during those days, it's quite likely that the bulk of those people lost money, and possibly continued to lose money in the aftermath, because people tried to kind of recreate echoes of this. And that's what's really weird about this, is because you had this real nihilistic element. if you look at the age group, and you're younger than me, Jack. I'm about to turn 54. If you look at the age group that participated in this at the time, was between the ages of 18, and males between the ages of 18 and 35 primarily. Their formative financial memory was not them, but their parents or their parents' friends, or whatever, losing a lot of money, perhaps losing their homes during the financial crisis, and why aren't the banksters locked up and whatever. I'm not going to get into a whole social commentary over,
Yeah.
where blame should be assigned for the global financial crisis, but that was a, you know, the kind of Occupy Wall Street type sentiment that a lot of them felt. And so they had a very dim view of Wall Street, and in particular, they had a dim view of short sellers, because people always have a dim view of them and don't really understand what they do. And then on top of that, if you're a short seller of a company, if you're kind of, people think that you're, purport that you're trying to destroy a company that was a big part of your childhood, like AMC Theaters and
Oh,
GameStop, which is a big part of my
yes.
son, exactly in that age range, right?
So you're
Uh,
trying to short the deli across the street, like,
yeah, you want to put GameStop out of business? What?
yeah,
Not that they were going to GameStop anymore, because they were like, they wised up. They were like downloading games, onto their, directly onto their PlayStation. They were going and trading games. They, when they were teenagers, they went to GameStop and got like ripped off. They'd go like, "Oh, here's my old game. Like, how much you give me for it?" And then get some credit. And then, yeah, that's mainly how GameStop made money, is all this sort of these physical discs that these teenagers would go in and trade in, and then get basically very little credit for, and then use it to purchase new merchandise or whatever. So that they weren't even doing that anymore. But hey, GameStop is part of my childhood. You're trying to destroy it, and you're a short seller, and you're a greedy hedge fund. You just hit the trifecta. I hate you, and I'm going to open an account. And it was this real nihilistic kind of thing, which is different than any of these other bubbles that you'll studying financial history.
hmm and now we have the element of the influencers. We have Chamath Palihapitiya, Elon Musk, and Dave Portnoy. Tell us about how impactful they were. I mean, just how much kerosene did they pour on this fire? And obviously, the counterfactual we'll never know. But you know, would it have been a lot less? You think if we didn't have these tweets out? And also, talk to it not as the editor of Her on the Street, or in the book you have a pretty objective tone, but I want your real opinion I want your judgment. So don't hold back.
Yeah, it's impossible to go and recreate history, as you said. No, in my opinion, and you can see it from the actual market reaction at the time, right? Elon Musk in particular, but Chamath for sure, going on CNBC and through his tweets, and Dave Portnoy, who had a very substantial social media following of young men in this cohort who were active day traders and active in this. All three of them, I believe, had a very substantial impact of egging people on, because they wanted to be with the cool kids. They wanted to sow a little chaos. I mean, I don't know. I think that, like, you can, when you unravel the threads of some big jump in some stock or something goes on financially, and you look at who made money, who profited, right? I mean, if you're like a detective, you're like, well, who profited from this thing? That's the person I'm gonna look for as a possible culprit. I don't think that any of them necessarily profited financially in a direct way from this, but it helped their brand, and your brand matters a lot. And in particular, I think that psychically they benefited from it. They were the cool kids. They were on the right side. They were on the side of justice. They were sticking it to the man. But those guys, they're all millionaires or billionaires. Two of them are billionaires. One is I think maybe just Dave Portnoy might still just be a mere millionaire, but they were already very wealthy people, and they were doing it, for the lulz, basically, and for the to enhance their brand. The bigger your brand, the more you're worth these days. And you know who the one influencer is who didn't stoke things on purpose? The only person who got investigated, by the way, was Roaring Kitty himself. Was at the center of this, because he could have come out. He was so much the center of attention. Even when he was anonymous, he could have said, "Oh, here's the next stock." He could have bought some way out of the money, call options on any thinly traded stock, and said, and just all he would have to do was have a screenshot of his brokerage account showing his position. People were tuning in every day to see that he still held on. If you had seen, out of the money call options on dog food company, whatever, they would have gone through the roof. He would have made 100 or 1,000 times his money. So he left a fortune on the table by being much more honest than these billionaires, in my opinion. He's clearly a very smart guy. He understood what he could do, and he didn't abuse his power.
Right. Do you have any sense? So he sold some contracts at the top, and I was surprised because I would have thought if he had sold some contracts that people would have turned against him, but no one did.
No, because he kept on holding on and holding on, and every day people are like, "Holy crap, he's still there! He's got balls of steel," And then you can go and look at all these messages, and I some of the kind of the more kind of PG rated ones are in my book, and some of them are not, and a lot of people went back and actually deleted their messages too. So it's not all there. It's archived, but it's not as easy to find. But yeah, people were just so impressed. They're like, well, hats off to him. Even when he sold over 2 days, a large part, closed out part of his options position, people were like, that's okay, that's cool. But some of his options, because you can settle it for cash, but you also can convert into shares. He had a lot of shares at the end of GameStop, so
Yeah.
he became a substantial owner by as late as that April, when he kind of went off, radio silent, of GameStop. So he stayed in there.
And probably I think they were so in the money, like they're never call options are never as in the money as those were. So it's pretty much is like he owned 100 shares. So it's you're never supposed to exercise an option, but probably the option value is not that much when you're the stock's at 400 and the strike price is at
12,
20.
$12, yeah, right?
12, yeah.
Yeah, yeah. No,
Um,
he did very, very well. He almost perfectly timed it, and then he held on to tens of millions of dollars in shares that he didn't really need to. He could have just walked away with much more money. I suspect he's he's different than these people too, who are on these boards, because he's a chartered financial analyst. Not that he was like of Wall Street. He was working, basically writing financial advice stuff for Mass Mutual. That was his job before he resigned during the week of the meme stock squeeze. Wisely, he was registered as a financial advisor, so he was investigated, and then his employer had to pay a fine for
what
not.
does he have to do these days? What has we been doing since then?
I think that he could easily, because he likes it. He could easily emerge as a sort of someone who bridges these worlds, who's a kind of a classic, kind of value investor, and go in and run a fund, kind of Michael Burry style, and someone who can speak to his generation. He was 34 at the time that this all happened, so he's very much in the kind of the age cohort at the upper end of it. But his use of memes and everything, he's funny. He knew exactly how to span those worlds. But the videos are all still online, and you can, he has hours long discussions that like maybe 20 people were listening to at the time. Now they've been viewed a lot, but at the time, he had very few people live on these, especially in the early days. He was just a curiosity. So I know no one's listening to this, but and he'd talk about Aswath Damodaran, and the value guru. No, I don't think that's a real household name on Wall Street bets. Even now, right? I mean, so yeah, he's an amazing character in my opinion, who could re-enter the financial world, and just on name recognition alone raise a ton of money, and probably deservedly so.
Yeah. Was there ever any hint from him that he thought this was getting out of control? I know Michael Burry said something publicly, said, "Hey, look, I'm out of the stock, and this has gone way beyond proportions." I mean, because Keith Gill, he's a smart guy. Something can't go up forever. People thought, oh, it's at 400, it'll go to 1,000.
Yeah.
If it had gone to 1,000, then people would say it got to 2,000, but it has to stop, and a crash was going to be imminent, and people were listening to him. I mean, I would feel a lot of pressure if, and this is a good part about both of our jobs, is that no one listens to us for investment advice, particularly about small. There's a small stock,
Right.
that I got in, and then it went 20x, and then everyone said, "Oh my God, Jack and Spencer were so successful. I'm going to get into stock." I would feel a lot of pressure, and I would want to say, "Hey, let's chill out here. Don't follow me. Like I'm doing it with my money. You do it with your money." But was there every sense where he kind of, and he never egged people on, but where no, there never was.
No, I think until December, when this wasn't in the headlines at all. It was just really being discussed on message boards, because it was already kind of building up some nice momentum. Probably not past the point of no return in terms of turning into the meme stock squeeze, but getting very, very close to that. He was explicitly stating his reasons. He was saying, I think this could be a short squeeze.
Uh-huh.
I, and then he kind of went radio silent in terms of commenting on it. He just just screenshotted his E-Trade statement, basically, once a day.
There was a time where you posted the Forrest Gump meme, right? Or was that after?
That was before.
That was before.
Oh,
Okay.
before, yeah. And so, yeah, he was just posting memes and stuff like that. And then he even slowed down with that. He just got basically just once during the thick of it when it was in the headlines. I mean, it must have been a very strange feeling for him. He would just once a day, people were waiting for him. And the fact that he was still in it as it was ramping up and up, and he already had life-changing money. He already had, he had taken 53 grand and turned it into, 40 million at one point. And I think he probably had turned it into about 70 million intraday at one point.
Mhm.
That's that's pretty good. I mean, it's 1,000 times your money, and I think that he was wary of explicitly saying buy this. All he was doing was giving what's called social proof, and social proof is a very, very powerful thing where you say, well, I'm doing that. That's how influencers work at the end of the day. Except he wasn't doing anything special other than just saying I still own it. Checking in end of the day after the market's closed, I still own it. He was doing it after market hours too.
Mhm. And so the week after, let's say the months after the squeeze, it collapsed in value and then recently reaccelerated, and that gave some hope to it. Tell us about the aftermath. There are a lot of people who didn't give up hope, and I mean, there are people still to this day who will say that the AMC stock is sold 300% short, and Wall Street's comparing there's a short ladder attack. Tell us about. We talked about the evolution of that community. Tell us, starting in February 2021 onwards, what has happened and what are your thoughts on it?
Yeah, I mean that to me is like a really crazy thing about this is I mean I knew within 10 minutes of seeing this as it was unfolding that I wanted to write a book about it because I thought it was like just a something that you know a financial phenomenon completely. I had no clue that years later, a couple of years later, we would still be talking about, the reverberations of it, or people have these really they're conspiracy theories. There's not 300% short interest. There's not going to be, if you Google MOASS, it's not a dirty word, MOASS, hashtag MOASS. I encourage readers to go and
Mother of all short squeezes.
mother of all short squeezes. Yeah, kind of like Saddam Hussein meets the stock market, right? I don't know what to say. I mean, it's the logic that people are using to point this out. They're taking some real numbers and piecing them together in a way that are difficult to understand, or not that difficult to understand, and pointing a picture of sort of you could justify anything that way. You say the Earth is flat or whatever. I mean, there are people who believe that, but there's not going to be a mother of all short squeezes. There's not some obviously there's this high short interest in these names because they're puffed up, right? And so there are always people who are saying, well, I think this is just stick a fork in it. I mean, AMC, you would have done really well if you had shorted AMC as the day that we're speaking, sometime earlier. And so there is actual short interest, but there's not some kind of conspiracy where there's shorts or synthetic shares or whatever people are talking about that have never covered. And so this into a kind of man on the grassy knoll kind of thing, where people just won't let it go.
And yeah, I mean, so much premium was burned as well. Not people, they bought AMC. It's not just they bought AMC at $100 and now it's at 10. It's they bought calls for it at 200, and they paid so much for it because the implied volatility was so high. Where does the movement stand today? What is the current state of the ape movement, given the tremendous fall in prices? I mean, GameStop, the fall has been large, but in AMC, I mean, that you really have had a momentous drop.
Yeah. No, I mean, if I tell you to do something that's outright gambling, right, and to keep on doing it, go to this casino. If you keep betting on black or you keep betting on red 23 or what have you, I just know it's gonna work because I have this convoluted theory of why it's gonna work. Some people will make money. It occasionally, every other time or so lands on black, or every once in a while lands on red 23. And so obviously there are people in spots who will make money listening to this really bad financial advice by people who are sort of just doing it really just for the influence, or for the views or for the subscribers on various social media channels. Or maybe they really believe it. I don't know. Some people actually do believe this stuff. But yeah, it's a way to burn up a ton of money. And especially if you're doing it through the options market, because the options market is already a sucker's bet. If you purchase options, whether they're call or put options, and in particular, if you're purchasing options in something that's very volatile, because the volatility, these stocks are all very volatile, and the volatility is part of the price. You're paying quite a bit of money. It doesn't seem like a lot of money, but I mean, if it doesn't seem like a lot of money when you buy a $2 lottery ticket 5 times a week for your entire life, and then you're like, wow, I just spent 70 grand during my working life on lottery tickets, right? I mean, it adds up, and that's kind of what's happening. Is you have these long shots with poor payoff odds. Occasionally, people are holding a gigantic check, and and are being interviewed on TV, but most often they're not making money. The math is not very different than lottery tickets. They're literally buying lottery tickets. If you look at the Options Clearing Corporation data, there has been an explosion in the most volatile type of options. And not just that the options turnover has risen a lot, but retail options turnover, and specifically things like 0-day options, options that expire during the day. There is no reason to buy stuff like that. That is a pure gamble. There's no valid financial reason to buy an out of the money call or put option expiring during the day unless you have some specific event, like maybe there's a Fed meeting and you're expecting Powell to say something, to pull off his mask, and it's Vladimir Lenin, under there, and he's whatever, right? Something just bonkers, right?
That
Unless you're
would be bonkers.
a crazy event, or you're positioning for some, earnings event, and you have a very keen insight, or you're just protecting yourself from volatility. There's no reason to make short-term bets like that. They're over time, they're going to be losing bets, and the options industry is very, very happy to take your money. They're hedged. They don't care. They're happy you showed up. Same thing with Robinhood. Same thing with Citadel Securities and its Virtu and its competitors that are market makers. They are just in the transaction business. They're not in the risk-taking business. And those are the people who made the most money on Wall Street during this whole episode, and all the ensuing echoes of it are people who are just very, very happy that a bunch of chumps, sorry to call them chumps, but a bunch of chumps showed up with their hard-earned money and gambled it, and mostly didn't make money. And they don't really care if you do or don't make money. It's not their, they like it when you make money. The casino likes it when you jump up and down and like whatever and make a big deal and lights go off and a bunch of coins spill out or whatever happens these days in the casino. I haven't been to one in a while, and you're like really, really happy. The casino lost money that second to you, but you're like, that's the kind of advertising that money cannot buy. You jumping up and down and making a big deal about it and putting it on social media, because then, 5 more people show up thinking that it could be them.
Yes, but the retail investors who bought short-dated call options on, low-quality companies that are, Warren Buffett would not invest in. Yeah, we both know what we mean. What I mean, that there could not have been a worse time to do that than April 2021 to, let's say, October 2022, because companies like Apple and Facebook, and they went down as well, and speculative stocks. I mean, like, the ARK ETF, unprofitable technology stocks, just had a horrible year as the Federal Reserve rose interest rates. So what is the state of the apes now? Or what was it maybe in October 2022 at the bottom of the bear market of 2022? And now that we're, in a somewhat more rosy bull market, pretty close to the S&P 500 to all-time highs, but on those speculative stocks, very, very far away. What is the state? I mean, how different is it in terms of, are people still buying a lot of these short-dated call options? Because I'll note that I think a lot of the one-day options for the S&P, I think those are like actually institutional investors who are just trying to get a little yield. Some of that, yeah.
There are people who are pursuing sophisticated financial strategies in order to extract yield, but we know that there has been a big rise in retail participation in the options market, and a lot of people don't understand what they're doing, or they do understand what they're doing, but they have a very poor assessment of their odds. And of course, there are people who, look, my dad and my father-in-law were both came to this country like literally with the shirts on their backs and, had very little money, and both of them happened to play the lottery and were totally equipped mathematically to understand that it's a losing game. They didn't waste a lot of money on it, but you need to dream. And so I understand the psychology. I don't want to denigrate anyone. The people will talk about the lottery and say that it's a tax on a numeracy or whatever. And it isn't really necessarily in a lot of cases, because people want to have this sort of, this one kind of feeler out there where, like, maybe their life can turn around and their life can be easy, whereas it's always been very hard and they've always had to struggle, and it's a small amount of money and you got to have a dream. And so I think that there's a numeracy for sure in retail participation in these options where they're, you know 60 or 70% of the time you're going to lose money. But there's also this sort of, wanting to hit kind of a lottery ticket type payoff. It's addictive. And by the way, and this wasn't the case like with my dad or my father-in-law, but in 3-4% of the population, there's a natural tendency to become addicted to the gambling element of it, and whether it's stocks or what's legally considered gambling, like betting on the spread on the Giants game. It's gambling. If you're betting on something or you have no special insight, you haven't done any analysis, you're not an investor. You're completely speculating. I don't really see much difference between it happening under the auspices of the New York Stock Exchange or the CBOE and happening on DraftKings and happening in the kind of a sports book. It's the same psychology. It's a very destructive psychology for some small percentage of people who engage in it regularly. That's a really sad thing about gambling, by the way, is that there are people who are addicted to gambling who will their entire lives will kind of fritter away their savings. They'll go and make more money, and then they'll fritter away their savings and hurt their relationships and spend their kids' money they should be saving for retirement or their kids' college or whatever on gambling. But at least when it was a casino in a couple of cities in America, they could stay away, or their relatives could keep them away. Now it's on smartphones everywhere. You can't really escape it. If you've developed an addiction, whether it's to gambling through on financial instruments or on roulette or whatever, it's very hard to escape. If you can, it's just so easy to download into your smartphone and set it up.
And the bear market, this is a permanent phenomenon, or unfortunately, permanent phenomenon that will, in a bear market and in a bull market, it'll be more extreme in a bull market, but it's not as if the bear market of 2022 killed the gambling spirit in
No,
America.
no, I don't think so. No, I think it dampened it. I think there are people who sort of said, you know what, I learned my lesson. I'm just going to buy index funds and not check my account. The less we know for a fact, the less frequently you trade, the less frequently you even look at your financial accounts, the better you'll do. There's an inverse correlation between activity and attention and and performance. And so there are people who definitely learn their lesson. You'll talk to people who are very kind of sober minds today, and if you get them, a few beers into them, they'll tell you some dumb thing they did early in their career. And I can tell you about some dumb things that I did when I first had a little bit of money and opened up a brokerage account. I mean, like, just really asinine stuff that I'm kind of embarrassed to talk about. But I mean, it was kind of a formative experience for me, and I can think back on that, and it was kind of a good tuition, right? I mean, it didn't cost me that much money because I didn't have that much money, and it kind of has informed me into the kind of prudent, boring guy I am today. And I mean, I can't do that because I write for the Wall Street Journal and can't gamble on the stock exchange, and I don't gamble on other things. But yeah, I mean, there are definitely some people who sort of they open the good thing that happened is that this got them to open a financial account and know how to buy stock, and then now they're on the kind of straight and narrow, or will soon be on the path to it. But a lot of people turned into sort of degenerates. And what the worst thing is that most people are not degenerates and not on the straight and narrow. Most people are somewhere in between. They open a financial account and they said, you know what, Wall Street is rigged. It's a crooked place, and they took away the buy button, and it's a conspiracy, and it's heads we win, tails you lose. And so I'm staying away from this place. And that's a really sad thing too, because the only way you can really kind of build up a big nest egg, other than kind of starting a business or maybe investing in real estate, is investing in financial instruments like stocks and bonds. It's the most transparent, available, straightforward way to do that. And the fact that a lot of people see Wall Street as inherently crooked, which it is not inherently crooked, in my opinion, and won't participate now because of this. That they're leaving a lot of money on the table in terms of just foregone savings because they're not participating. That's bad too. That's the worst thing of all.
Right. And yeah, Wall Street not inherently crooked, but encouraging this gambling because it makes them a lot of money.
Yeah, you know the what people accused Robin Hood's representatives. This is like real chutzpah, in my opinion. They came out and they attacked Charlie Munger and Warren Buffett, 90-something-year-old billionaires, for basically calling it, rat poison and whatever. They not only do they have nothing to gain by stating very clearly that this is like, this is a very destructive financial habit that people have, betting on these meme stocks and betting on SPACs and betting on all these very speculative financial things that entered our financial lives in the last few years, and crypto also. Not only do they not have anything to gain by saying that, but they actually have something to lose. Because if you're Warren Buffett, why is Warren Buffett Warren Buffett? Finance is a zero-sum game. In order for Warren Buffett to have made, many multiples of the S&P 500's return, you have to have someone else who is on the losing side of all those trades, who is basically contributing to his fortune, right? And it's people who are impatient and poorly educated and what or just unlucky in many cases. You don't make the money without someone losing. Wall Street is very, very happy that these people showed up. They're mostly staying pretty quiet about the arrival of this young, very speculative generation, because it's a great thing for Wall Street.
Right. Although I say Warren Buffett is benefiting, and Berkshire Hathaway shareholders benefiting from mispricings of people selling banks in 2009, or selling Coca-Cola in 1994. Like the people who are benefiting directly from the retail speculation orgy boom, to use the Charlie Munger quote, is Virtue Financial, Citadel, and Robinhood. Spencer, so Robinhood, I took a look at their quarterly presentation, and what do you know that right now their biggest revenue driver is not transactions, it's not options volumes, it is interest income. So the biggest line item for the top line revenue for Robinhood is not a casino, it's now a bank. What does that say about that business model? I mean, because the speculation has gone down 80% from January 2021, but down 80% is still up 500% from normal levels.
Right. Well, one thing it tells you is that overnight interest rates in this country went from 0% to 5.25%. So there actually is interest again to be earned, which is a really important component of the earnings of a Charles Schwab or anyone like that, where their clients actually have a lot of money. And Robinhood is turning into a normal broker. They're going to offer IRAs and stuff like that. They're making money on cash balances. They're making money on margin lending and stuff like that, which is really is the way that brokers make money. When they like Charles Schwab and all those guys were really worried when they took commissions down to zero. But even then, in late 2019, they weren't making a lot of money on commissions. That's not how brokers make money anymore. They make money on, offering you all kinds of financial services and offering you a credit card with rewards and holding your money and paying you too little for it, or lending you margin. That's the revenue model of all these firms. So Robinhood is a little bit more like a normal broker now than the kind of YOLO broker. Unfortunately, it's difficult for them to make a lot of money because their customers, they have a lot of accounts. It's expensive to maintain an account. Not really expensive, but it does cost money. There's IT and overhead and admin and stuff like that. So they don't give you a lot of support. Obviously, you can't. It's very hard to call up Robinhood and talk to a person. If you have $20 in an account, then they're not gonna really help you a lot.
The only way for it to be profitable is for the $20 person to speculate. A $20, buying VOO, which has a Vanguard ETF for SP 500 that has 3 basis points, it's not a profitable. They need that person to speculate.
But here's how you stick it to the man, Jack. You buy VOO and you forget about it, right? You forget you own it, right? That's because they still have to honor your account. They still have to keep it open. It costs them a few bucks a year to keep your account open, and they're earning like a few cents a year off of you. They're not even earning a few cents a year off of you. They're like some fund companies is earning it, and they're getting it rebated. They made money the one time you bought VOO, and they'll make money the one time you sell VOO, which is like a fraction of a penny, So you want to stick it to the man, then be boring like me, and that's really how you if you're nihilistic and you want to hurt Wall Street, you can actually do it. It's like a twofer. You can make money and stick it to the man, right? I mean, by just being totally passive, and low cost. It's not as exciting, you can't brag about it on TikTok or on Reddit, but that's the actual way to kind of pull one over on Wall Street, is they have to provide you with this account. It wasn't possible a long time ago. All these charts they show you, if you had invested $100 in 1926, it would have compounded into, no, it wouldn't have, because just reinvesting the dividends cost money. There was no index fund. You couldn't, whatever, right? I mean, that's not really true. And they would have had to have a ton of money just to open a brokerage account by 1926 standards. But today it's possible, because, and who's covering your expenses is all the people who are very active. That those are the people who were making it, or leaving cash uninvested or whatever. Like, those are the people who subsidize the brokers, and you can be the kind of economic free rider on all that stuff.
So explain, I have two more questions. Explain for me this paradox where over the past 20, 30 years, the Jack Bogle revolution, people are allocating to S&P 500. They've been learning that, I'm paying a very small fee. I'm not trading in, trading out. I'm exposing myself to these behavioral foibles. So I think now over 50% of at least US dollars invested in the stock market is passively managed. So, if Apple has a good quarter, bad quarter, someone posts something on Reddit, they don't care. They're just, I'm owning it, and it's methodical. Explain how, at the one hand, we've had this boom in passive, so it's not trading in, trading out. But on the other hand, we have this orgy of speculation. How can those two things exist at the same time?
Because it's not the same people in human psychology. You can say that, like, people learn their lesson, right? You could say people learned their lesson in 1929, right? You had a whole generation that was scarred, where, like, in 1932, the predecessor to the S&P 500 didn't exist yet, was trading at like 5 times earnings and had a 7.5% dividend yield. I mean, it was like, what a fat pitch, just to put your savings into it. And don't worry about the ups and downs. Don't worry that there was another recession in 1937. Don't worry about World War II. Don't worry about anything. You just, own a bunch of blue chip stocks, and you would have made a complete fortune. But no one did, or very few people did. Obviously, someone bought stocks, but you had a generation that was permanently scarred. It wasn't until the 1950s, when you had a completely new generation, that you had a new bull market begin. And so that's part of the explanation for why these cycles recur, is that it's different people, or people with relatively short memories, or the devastation wasn't deep enough to completely dissuade people. There are people who would have, like, maybe they lost their shirts last year, and now they're tiptoeing back into the water, and they're buying ARM or Instacart or whatever on the day of its IPO, 30% above the IPO price, because of course they couldn't get allocation. So there's a never-ending supply of people who think, despite the evidence, even whether or not they understand the evidence, that they can outsmart Wall Street, or that they can pay someone. And it's very alluring. People who say, give me your money.
Yeah.
I can outsmart Wall Street. I can
Wall Street can't outsmart Wall Street.
Well, a few people can, but I think there's a very tiny slice of people who have actual skill in investing. And there are people who are lucky. If you had invested money with the fund manager of the decade a decade ago, you would have done really, really badly. I mean, even like what seems like a pretty long track record is very difficult statistically to differentiate from luck. And maybe they actually were good and they just had bad luck this decade. It's really, really, really hard to tell. But people are very prone to believe that skill exists, that they have skill, that they'll be different, that they have some special insight. And so, yes, I mean, the fact that passive investing has grown so much is really a threat to Wall Street's money machine. But they found other vehicles, including most recently the meme stock squeeze, and drawing in all these young investors. Not that they did it deliberately, but I mean, of course, the advertising was very much geared towards drawing those people in. Please go on YouTube and look at the historical ads for all these brokers, or go back and look at the E-Trade ads, which are still online from the .com boom. My favorite ad is some stockbrokers broken down on the side of the road, and a truck driver comes and picks him up, his steam coming out of his his sports car, and he's got like Barron's open because there's no, you can't trade there's no smartphones yet. Because, oh, you trade stocks online? Yeah, yeah, I'd do a bit, a customer of E-Trade, goes, yeah, that's a and what's that picture? Like, it's like, oh, it's a picture of my island, technically it's a country, and basically how like this guy who's just kind of picking people up for fun, who's made so much money that he's outsmarted this slick Wall Streeter. That's always the dream. That is a message that's been repeated again and again and again. You can do it. Put your chips on the table. And so, I mean, casinos are not allowed to do that because you actually have a proven losing record in casinos. But you're not like a lot better. I always hesitate to call Wall Street a casino because it isn't. It's obviously it's a place to allocate capital and stuff like that at its core.
So final question for you, Spencer, is do you think there's going to be another GameStop, another AMC? And if not, why? Has there been new regulations, changes to market structure, or is it just that the market makers for short dated call options are going to sell it at a 200 vol instead of a 40 vol, so the snowball never turns into an avalanche?
Yeah, I think it was a very unique set of circumstances. I think that there will be many mini ambushes, so many small versions of it. And there already have been, where someone on Wall Street got caught on the wrong foot and had to scramble or got blown up and had to cover their shorts. But I think that the people who allocate money on Wall Street have really wised up, and they understand the power of social media today. And so it will be much more difficult to like have like an open ambush where openly discuss, hey, we're going to jump on this guy and talk about it for weeks and weeks and weeks and spell out exactly how you're going to do it, and then still get away with it and do it like that. That's not going to happen again.
Got it. Well, Spencer, thanks so much for joining us. Again, your book is The Revolution That Wasn't: GameStop, Reddit, and the Fleecing of Small Investors. Thanks for coming on, and thanks everyone for listening.
Thanks for having me.